Welcome back to this special Talk Tickers edition of the Deep Dive. Today we are unpacking the American Airlines Q2 2026 earnings call.
Yeah, ticker AAL for those following along.
Exactly. And our mission today is to cut through all the corporate fluff and give you, the retail investor, the actual headline numbers.
Right. The story behind them, management's guidance, and, our final verdict, all at lightning speed.
Well, as lightning speed as we can manage with this much data, because, I have to start with an analogy to even wrap my head around this quarter.
Oh, I love your analogies. Go for it.
Okay, so imagine you own a restaurant, like a really, really nice one.
Okay, I'm with you.
And business is absolutely booming.
Okay.
Like, there is a line out the door.
Yeah.
Every table is booked.
Sounds like a good problem to have.
Right. And your customers aren't just buying the standard burger. They're ordering, the dry-aged ribeye. They're getting the expensive wine.
So high-margin stuff.
Exactly. You are pulling in record revenue. The cash register is practically singing. But then, and here is the catch, you go into the back office, you open up your utility bill, and you realize the cost of the natural gas you use to heat your stoves has just gone up by 83%.
Wow. 83?
Yeah. Suddenly all that record-breaking money you're making in the dining room, it's getting completely burned up in the kitchen.
That's exactly the nightmare scenario American Airlines woke up to in this second quarter.
It really is. Do you close your doors? Do you start serving less food? Or do you just kind of weather the storm and hope the price of gas comes back down?
Which is the ultimate question for anyone holding this stock right now.
So let's drop the headline numbers. Because American Airlines achieved record quarterly revenue.
Right.
Up a massive 16.3% year over year, which is huge.
In a legacy, mature industry like airlines, double-digit top-line growth is a massive achievement. The business is generating more cash than ever.
But then fuel expenses just devoured those gains. Skyrocketing by over $2.2 billion.
Yep, compared to the previous year. It's wild.
A $2.2 billion increase in a single expense category in just 1 year. That isn't just a hurdle. That is a brick wall.
It really is. And for the listener, if you are holding American Airlines stock or any airline stock, you aren't just betting on whether people want to fly.
Right. You're basically placing a highly leveraged bet on the global commodities market.
Exactly. But we have to translate this because management always points to macro factors when they lose money.
Oh, 100%. But they take all the credit when things are going well. So how do we actually know if AAL is being managed well?
Well, we look at a very specific Wall Street metric called KSMX.
KSMX. Okay, translate that for us.
It stands for cost per available seat mile, excluding fuel.
Okay, so how much it costs to fly a seat 1 mile, ignoring gas prices?
Precisely. The available seat mile, or ASM, is the fundamental unit of inventory.
Whether the seat is full or empty, right?
Right. And you take all the operating costs, pilot salaries, aircraft maintenance, gate fees, the pretzels, and divide it by those seat miles.
But you strip the fuel out entirely.
Exactly, because fuel is volatile and outside the CEO's control. So KSMX tells you if management is running a tight ship.
And how did American do on that front?
They held their non-fuel unit cost growth, their CPAS-MX, to under 3% for the quarter.
Under 3%. With general consumer inflation running so hot, that's actually astonishing.
It's a phenomenal operational achievement. It means they are wringing out efficiencies everywhere on the ground.
Okay, but this brings us to the central conflict, right?
Right.
You can build a hyper-efficient sports car, but if gas is too expensive to put in the tank, it just sits in the garage.
True.
So if fuel is eating their lunch, how on earth did they still manage to hit that record 16.3% revenue growth? What's the bull case here?
Well, to understand the revenue engine, we have to look at what the CEO, Robert Isom, calls their 4-pillar strategy.
Okay, lay them out for me.
Elevate the customer experience, grow the global network, drive premium revenue, and lead in loyalty.
And I'm guessing one of those is carrying the team right now.
Oh, absolutely. The absolute standout is the 3rd pillar, the massive shift toward premium seating.
Yeah, this data drop completely altered how I view the company. Premium unit revenue grew by 13%.
Which outpaced their main cabin growth by 5 full points.
But the crazy stat is this. Nearly 50% of Americans' ticketed revenue now comes from just 30% of their seats.
Just think about that geometry. Half the money from less than a third of the physical footprint.
It's like a movie theater where half the box office is coming from those few VIP recliner seats in the back.
That's a great way to look at it. And the demographic data makes it even more stark.
Right. What was the household income stat?
60% of their total revenue is coming from households making $150,000 or more.
Wow. So they're essentially turning into a luxury brand. They're kind of abandoning the budget traveler.
It's like a freemium software model. The people in the first class lie flat suites paying $5,000. They're the enterprise subscribers.
Covering the fixed costs for the whole metal tube.
Exactly. And the basic economy folks in the back paying $250 are the free users. The airline barely profits on them.
But wait, is there a ceiling to this? If we hit a recession tomorrow, aren't they stuck with a fleet full of expensive lie-flat seats?
That's the risk Wall Street probed during the Q&A. But American has a defense mechanism, the algorithm.
Ah, the upsell.
Yes, they reported a 5-point increase in travelers upgrading from basic economy to main cabin.
So even the budget travelers are coughing up a little extra cash.
Right. Through dynamic pricing in the app.
Yeah.
5 days before a flight, if first class isn't full, you get a push notification.
Like upgrade to first class for $150.
Exactly. For the airline, that is pure margin. The physical seat was flying empty anyway.
That's brilliant yield management. But it's not just wealthy families, right? The business traveler is back too.
In a massive way. Managed corporate revenue surged 26%.
26%.
Yeah, their 5th consecutive quarter of double-digit growth. And revenue from small and medium enterprises jumped 42%.
So it's consultants, regional sales managers getting back on the road. And they pay top dollar.
They book late, need refundable tickets, and fly premium. They are the holy grail.
Which brings us to the network side. To catch those corporate travelers, you need a tight schedule. Management talked a lot about Dallas-Fort Worth.
Yes, their most important hub.
They said they rebanked the schedule at DFW. What does banking actually mean for a retail investor trying to understand this?
So a bank is basically a highly choreographed rush hour at the airport.
Okay, so planes all landing at once.
Exactly. A massive wave of inbound flights lands within a narrow 30 to 45-minute window. Passengers get off, grab coffee, swap planes.
Bags get aggressively tossed around by the ground crew.
Right. And then a massive wave of outbound flights takes off. That cycle is one bank.
Sounds efficient, but also like a house of cards if there's a thunderstorm.
The whole thing fractures. Connecting passengers sprint, bags get lost, crews time out due to FAA limits.
So a 20-minute delay can cost millions?
Easily. So American rebanked DFW to a 13-bank structure. They slightly spaced out the arrival and departure waves.
Giving a little more buffer time. Did it work?
Flawlessly. They reduced missed connections by 25% year over year.
Wow, 25%. That saves so much money on hotel vouchers and rebooking.
And because of it, DFW unit revenue outperformed the system average by 4 points.
That's a huge operational win, and internationally.
London unit revenue was up an incredible 20%.
London. That's the most competitive premium market on Earth.
Yep. And American is deploying their flagship wide bodies there, capturing that transatlantic corporate traveler.
Okay, so the network is humming, the premium seats are selling, but we have to talk about the fourth pillar, loyalty.
Ah, yes. The Advantage program.
Because these modern loyalty programs aren't just frequent flyer clubs anymore. They are essentially unregulated shadow banks, right?
Shadow bank is entirely accurate. Enrollments jumped 32% year over year.
And they saw huge growth in jump ball markets like NYC, Chicago, LA.
But the real cash cow is the credit card. Spend on their Citi co-brand card grew 8%.
Okay, break this down for me. How does American actually make money when I buy a latte with my Advantage card?
It's brilliant. You earn 1 mile, right? But Citi doesn't own that mile. American does.
Like a central bank minting fiat currency.
Exactly. American mints these miles out of thin air and sells them to Citibank for cold, hard cash.
So Citi pays American hundreds of millions of dollars up front.
Yes. The cash flow is immediate. The liability giving you a free flight someday is deferred.
An American could just devalue the miles whenever they want anyway.
By just requiring more miles for a ticket, it's a closed-loop ecosystem.
So the underlying business looks unstoppable. Premium seats, tight hubs, printing money with credit cards.
It does, which makes the management guidance section of this call so completely jarring.
Right. This is where we have to pivot to the bear case. Because they dropped an absolute bomb on their full-year guidance.
A whiplash-inducing turn, for sure.
The CFO, Devin May, laid out a timeline that is just terrifying. He said 3 weeks prior to this call, they were projecting a full-year profit of $1.5 billion.
4 times their 2025 income.
Right. They were probably popping champagne in the boardroom. What the heck happened in 21 days?
The global oil markets shifted violently. The forward fuel curve skyrocketed.
And what are they expecting to pay now?
Jet fuel is expected to spike to $3.75 per gallon in the third quarter.
Which is Catastrophic, I'm assuming.
Absolutely. So they slashed that $1.5 billion profit guidance down to somewhere between a loss of 65 cents and a profit of 65 cents per share.
So they might actually lose money this entire year just because of a 3-week oil spike.
Q3 alone is expected to see a loss of 70 cents to $0.10 per share. It's a $1.7 billion year-over-year fuel headwind.
Okay, so putting on my retail investor hat here, if I run a delivery business and gas goes to $10 a gallon, I park the vans.
Sure, that's the rational instinct.
So if flying a Boeing 777 to London is going to lose money because of fuel, why aren't they grounding planes? Why are they still growing capacity?
Dwayne from Evercore asked that exact question during the Q&A.
Really? What did he say?
He asked, why isn't the low-margin producer cutting to the bottom? Why no urgency?
And what's the answer? Because an airline isn't a delivery van.
Right. It's governed by massive fixed costs. The planes cost $100 million.
So whether it flies or sits on the tarmac, you still have to pay the lease.
Exactly. Plus astronomical gate fees at the hubs and the labor force.
Right. You can't just tell 15,000 union pilots to take the month off unpaid.
You're legally obligated to pay them their minimums. So grounding the plane covers zero fixed costs.
It's actually less financially damaging to fly the plane at a slight loss.
Because the ticket revenue offsets some of the cash bleed.
That is a terrifying trap. So what is management's action plan?
They are cutting back just modestly. They trimmed Q3 capacity growth by 2 points down to 3% to 5% growth.
2% feels like bailing out the Titanic with a bucket.
It does, which is why they are relying on balance sheet liquidity. They have $11.3 billion in available liquidity.
So that's cash, short-term investments, undrawn credit lines, and emergency war chest.
Exactly. It guarantees they can pay the leases and make payroll even if they bleed cash at the pump.
They also secured $1.3 billion in new financing during Q2, right?
Yeah, preemptively taking care of their 2027 debt maturities so they don't face a liquidity crisis next year.
Smart. But what about their long-term strategy? All those premium seat retrofits cost a fortune. Are they freezing that to save cash?
Actually, no. And that's the most bullish signal in the whole call.
Oh, really?
They are holding CapEx steady at $4 billion, mostly to keep retrofitting planes and adding Starlink Wi-Fi.
So they know the premium strategy is their only long-term salvation. If they stop now, they lose the moat.
Exactly. They're absorbing the short-term pain. And speaking of moats, there is a hidden gem in the Q&A about labor costs.
Oh, right. Because everyone in the industry is dealing with union strikes and demands for huge wage hikes right now.
Right. The whole industry is staring down massive pending union contract hikes, except for American Airlines.
Wait, really?
CEO Robert Isom pointed out that American already settled their major contracts.
So they already have those top-tier wages baked into their numbers.
Exactly. When they report that sub 3% KSMX, that already includes paying pilots top dollar today.
That is wild. So their competitors look cheap on paper now, but they're sitting on a ticking time bomb of labor inflation.
Isom called it labor cost certainty. For the next 12 to 18 months, American knows exactly what their labor will cost.
That is a phenomenal competitive advantage.
It really is.
Okay, we've covered a ton of ground. The 13% premium growth, the DFW optimization, the $3.75 jet fuel nightmare. It's time for the bottom line.
The talk ticker's verdict.
Exactly. If you're a retail investor holding AAL or eyeing the dip, what's the actionable takeaway?
We have to take a bifurcated stance here.
Right.
Short-term, bearish, long-term, bullish.
Okay, defend the short-term bear case first.
Over the next few quarters, this stock is a hostage to the oil markets, period.
It doesn't matter how great the yield management is.
Right. If jet fuel stays at $3.75, it mathematically suppresses earnings. You can't out-merchandise an 83% spike in raw materials.
The physics just don't work.
So the stock will likely remain depressed as long as that crack spread is wide.
But the long-term bull case.
That's where the thesis lies. Look past the commodity shock. Their cost control is best in class.
That sub 3% KSMX.
Yes. They have labor cost certainty, massive corporate travel recovery, and they've successfully pivoted to a premium luxury brand.
Targeting those $150 households.
Exactly. So historically, commodity spikes normalize. The second jet fuel prices drop back to average, Americans' profit margins are primed to explode.
Because the efficiencies in the high-yielding revenue streams are already in place. The weight just lifts off the bottom line.
They've set the table perfectly. They're just waiting for the ingredients to get cheaper.
That is a very compelling thesis.
Yeah.
But before we wrap, I want to leave you, the listener, with a final provocative
Well,
thought.
this is the Southwest news, isn't it?
It is, because Americans spent this whole call touting their dominance in premium seating as an impenetrable moat.
Their golden goose.
Right. But during the media Q&A, a Wall Street Journal reporter brought up Southwest Airlines.
Right.
Southwest just announced they are abandoning their famous open seating model. They're shifting to assigned seats, adding extra legroom, and adding premium seating.
It's a seismic shift for the domestic industry.
They are executing a massive pivot to chase the exact same corporate and premium traveler that American relies on.
Which introduces a huge unknown into the supply and demand curve.
Exactly. So, as an investor, you have to ask, can American truly defend this premium empire? If Southwest floods the market with thousands of new premium seats, does Americans' pricing power hold up?
Can they still charge that 5x multiple if Southwest is offering a competitive product for cheaper?
It goes back to the restaurant metaphor. You can survive a gas spike if you're the only place serving steak to wealthy execs.
But what happens when the fast food joint across the street puts out white tablecloths and starts serving steak too?
Exactly. That is the reality American is flying into next. And it will dictate if this strategy is a permanent moat or just a temporary bump.
Something to watch very closely.
Absolutely. Well, thank you for joining us on this deep dive into the numbers, the narratives, and the harsher realities of the airline industry. We'll see you next time.